Hi, I'm Pat McParlin from CreditRiskMonitor, and today I'm delighted to be with Dr. Edward Altman at the New York University Stern School of Business. Dr. Altman is the Director of Credit and Fixed Income Research. He's an international expert on corporate bankruptcy, distressed debt, high yield bonds, and credit risk analysis, and he has been named one of the 100 most influential people in finance by Treasury and Risk Management magazine. That's quite a lot of accomplishments there, Dr. Altman. So happy to see you today.
Happy to be here, Pat.
Great. So the last time you and I chatted was last summer, and at that time we were talking about the possibility of a credit bubble and might it burst in 2016 or 2017. And I'd like to see where you think we are today and also your perspective on the last 6 months.
Yeah, a good way to phrase where we are today and frame it is a baseball analogy. I think back last summer, I was saying that we were probably in the seventh inning of the benign credit cycle. We define a benign credit cycle as low interest rates, low default rates, high recoveries on defaults if they take place, and high liquidity. Things have changed quite a bit, Pat, since last summer, and I'm debating now whether or not we're in the ninth inning and therefore almost over, or indeed the benign credit cycle is over, and we are looking at a bubble which is not only building, but getting close to bursting in the credit markets.
Okay. Well, as I told you last time, I'm not a huge baseball fan, but I do understand the ninth inning, so that's great.
Yeah. By the way, the ninth inning usually signals the end of the game. However, the score could be tied. And if the score is tied, we could have extra time, and the main motivator in this case will be the Federal Reserve, and whether or not they change their strategy and become much more aggressive again by providing vast amounts of liquidity to the market to try to buoy up what has come in the last, particularly in the last month or so, to be a very risky, high interest rate environment, difficult and dangerous.
One of the things we talked about last time and is in the news quite a bit now is the risk, if you will, in different industries. For example, oil and gas is in the news every day, metals and mining. What's your perspective on different industries? Is it solely in those? Is it more in some than others? I'd love to hear your perspective on the industry aspects of this.
Well, there's no question. Oil, gas, mining, coal in particular, besides oil and gas, have done terribly poorly in the last year. Indeed, 43% of all large bankruptcies are from the oil and gas and mining sector. 57% of all defaults in the high yield bond market are from those sectors. So they dominate. So oil and gas, no question, the leader, and it'll only get worse. It's not going to get better, unless, of course, the price of oil jumps above $50 a barrel, which is not likely to do in the near term. Other sectors to be concerned with are maybe some of the usual characters, so to speak. There's the retailers, with both dropping revenues in retailing and lower prices in some of their other assets like real estate will cause a increasing number of very large bankruptcies in that sector. Most of the headlines are negative, not positive. And that, of course, causes markets to cringe and to cut back and a flight to quality more to the government bonds.
What final advice or thoughts might you have for our audience who, as a reminder, are credit and supply chain professionals? What thoughts do you have for them operating in this kind of environment?
Well, certainly all companies, regardless if they're selling only to investment grade companies or both investment grade and high yield or non-investment grade, need to, in this market, in this environment, exercise increasing caution, prudency with respect to not only ratings of companies, but their own assessment of the repayment risk, which is always an important factor, but now becomes a critical factor. That you just don't sell to a company and say, well, they paid in the past, therefore they're going to pay again. You're going to be looking at the environment that these companies operate in and say, if there is a material chance that they won't, I'm going to maybe continue to sell, but increase my reserves for bad debts, or actually, in some cases, cut off selling where the company has deteriorated dramatically.
Makes sense. So it sounds like looking at kind of the overall environment and the context in which the company is working in their financial health and not just, their past behaviors. I think that's
Exactly.
really good advice.
You always should be looking into the future.
Mm-hmm.
And past behavior is somewhat of an indication of the future, but it's oftentimes misleading, especially when we go from a benign credit cycle period to one that is just the opposite.
Well, thanks, Dr. Altman. Look forward to talking to you in March and diving a little bit more deeply into some of these areas. I do have one final question for you,
Sure.
which is, what do you think, Yankees or Mets?
Well, the Yankees did shore up their pitching, assuming that they get the closer that they're hoping. But the Mets definitely look like a stronger bet for next year. I hate to say that because I've been a dyed-in-the-wool Yankee fan from day one in my life, just about. And but I did root for the Mets this year because, frankly, the Yankees didn't have it.
Okay. Well, we'll check back on that point too.
Yeah.
So
Yeah,
thanks
my
for having
pleasure.
me today. Great talking to you.
My pleasure.